While American missiles were still falling on Tehran, a Chinese cargo ship was quietly loading Iranian crude oil in the Persian Gulf, not secretly, not illegally, openly, because the chemical that powers this transaction is not banned by any sanction on Earth. Here is the number nobody in Washington wants to say out loud. In 2025, China imported an average of 1.38 million barrels of Iranian oil per day, every single day, at a discount of $8 to $12 below global market price. That means while the United States was spending $1.5 billion per day prosecuting a war designed to economically strangle Iran, China was buying Iranian oil at the steepest discount in years, saving billions, funding the very economy that funds the missiles being fired at American bases. This is not a coincidence. This is not an oversight. This is the most sophisticated economic warfare strategy of the 21st century, and America walked straight into it without asking a single question about who was going to benefit. To understand what is really happening here, you need to understand that there are three completely separate wars being fought simultaneously, and only one of them involves missiles. The first war is the military conflict everyone is watching. American and Israeli strikes on Iranian nuclear and military infrastructure, Iranian missile salvos in response, Strait of Hormuz disruptions. This is the war on television. The second war is the economic war that Washington believes it is winning, sanctions, asset freezes, secondary sanctions on Chinese terminals receiving Iranian oil, 6 Chinese port facilities blacklisted by the U.S. State Department in 2025 alone for receiving Iranian crude. This is the war in the financial press. The third war is the one almost nobody is covering. It is the war China is winning without firing a single shot, without deploying a single soldier, without violating a single international law that Washington can point to. China entered 2025 importing roughly 10 million barrels of crude oil per day. Of that, approximately 1.38 million barrels, nearly 14%, came from Iran, not from Saudi Arabia, not from the UAE, from sanctioned Iran, purchased at $8 to $12 below global Brent benchmark prices. Now do the math. 1 million barrels per day at $10 discount equals $10 million saved every single day. Across a full year, that is roughly $3.6 billion in annual savings flowing directly into Chinese refinery margins. Margins that state-owned giants like Sinopec use to fund their global expansion, while American companies pay full market price for their energy. Iran needs China to survive. China needs Iran to stay cheap. And America needs to understand that these two needs have created a closed economic loop that no missile strike can break. Here is the part of this story that reveals exactly how sophisticated this arrangement actually is. China's state-owned oil giants, Sinopec, CNPC, the companies whose names appear on stock exchanges and in diplomatic communiques, are not the primary buyers of Iranian crude. They stepped back from direct Iranian purchases in 2018 when U.S. secondary sanctions made the risk too visible for companies with global financial exposure. Instead, the buying shifted to what the industry calls teapot refineries. These are independent processors concentrated primarily in Shandong province, operating on margins so thin that without discounted Iranian crude, many of them would not be profitable. According to multiple market analyses, these teapot refiners control roughly a quarter of China's total refining capacity and have been running on Iranian oil as their primary feedstock for years. The arrangement works like this. Iranian crude is loaded onto tankers that disable their AIS tracking systems in international waters. The cargo is transferred ship to ship near Malaysian waters, relabeled as Malaysian Light or Oman Blend, and delivered to Shandong terminals that do not ask questions they do not want answered. By the time the oil reaches the refinery, it carries no Iranian fingerprints. The payment routes through Chinese banks operating entirely outside the U.S. financial system. The profit stays in China. The revenue flows back to Tehran, and the cycle repeats. Every single day, 1.38 million barrels at a time. When the U.S. sanctioned the Haidongjiakou terminal in Qingdao in August 2025, one of the primary Iranian oil discharge hubs, Iranian imports simply shifted to Huangdao, another port in the same province. Within weeks, Huangdao was processing double its previous volume of Iranian crude. You cannot sanction geography. Now, here is where the analysis becomes genuinely uncomfortable for anyone in Washington who has been celebrating the economic pressure campaign against Iran. Every barrel of Iranian oil that China buys at a $10 discount is a barrel of revenue flowing into the Iranian state budget. That budget funds the IRGC. The IRGC funds missile production. Missile production funds the Fatah 2 program. The Fatah 2 program fires at Israeli command centers and kills senior IDF officers. The chain is direct. The math is simple. And the actors who designed this system understood the chain perfectly before the first sanction was ever written. Consider the numbers from the perspective of military economics. The United States spends approximately $1.5 billion per day prosecuting this war. Iran, according to IDF estimates, rebuilt its missile arsenal from 1,500 to 2,500 ballistic missiles in 8 months, funded substantially by oil revenues flowing through Chinese teapot refineries in Shandong province. The cost to rebuild one Khaybar Shikan missile, approximately $1 to $3 million. The daily oil revenue flowing to Iran through Chinese purchases at 1.38 million barrels per day, even at depressed prices, approximately $83 million per day at $60 per barrel. In 8 months, that revenue stream generates roughly $20 billion, more than enough to rebuild every missile Israel destroyed, replenish every launcher eliminated, and fund the next round of conflict before the current one has even ended. America is spending $1.5 billion per day on a war. China is collecting a $10 per barrel discount on 1.38 million barrels per day, saving $13.8 million daily, while the war that generates that discount continues. Every day the conflict extends, China's energy cost advantage over Western competitors deepens. This is not ideology, this is arithmetic. The Romans understood this pattern 2,000 years ago. When you besiege a city, you must first cut all supply lines, every road, every river, every trade route. If one supply line remains open, even one, the siege fails. The city receives enough food, enough weapons, enough morale to outlast the besieging army. The British naval blockade of Napoleonic France failed for the same reason. As long as neutral powers continued trading with France, and they did, because profit is more powerful than political alignment, the blockade could not strangle the French economy into submission. The sanctions regime against Iran has the same fundamental structural flaw. It attempts to besiege an economy while leaving one supply line, China, completely open. And that supply line moves 1.38 million barrels of oil per day. History offers one precedent where economic warfare actually worked: the Allied blockade of Germany in World War I. It worked because Britain controlled the seas entirely, no neutral power was large enough to compensate for the loss, and Germany had no alternative supply chain. None of those conditions exist in Iran's case today. China is not a neutral small power. It is the world's largest crude oil importer, the world's second largest economy, and a permanent member of the UN Security Council with both the capability and the strategic incentive to keep Iranian oil flowing, regardless of what Washington demands. The word that comes to mind is the same one the ancient Greeks used to describe the fatal miscalculation of powerful empires: hubris. The belief that your power is so absolute that the rules of economics, geography, and history simply stop applying to you. Here is the consequence that no analyst in Washington appears to be running through their models. The war in Iran has pushed Brent crude above $100 per barrel. Every barrel China buys from Iran at $10 below. Brent is now a $10 discount against a $100 baseline, saving Chinese refiners more per barrel than at any point in recent years. The war that was designed to economically pressure Iran is simultaneously delivering China its largest energy cost advantage in a decade. Meanwhile, China has been quietly stockpiling. According to Vortexa Analytics data from late 2025, onshore commercial crude stocks in Shandong province reached 293 million barrels, a record high. China has been accumulating crude at approximately 1 million barrels per day above consumption needs. What does a country do when it has record crude stockpiles, a supplier selling at maximum discount, and a geopolitical rival burning $1.5 billion per day in a war that shows no clear exit? It waits, it watches, and it positions itself for the world that comes after. When this conflict ends, however it ends, Iran will need reconstruction capital. China will be the only economy with both the liquidity and the political relationship to provide it. When Gulf states reassess their security relationships after watching 6 American allies refuse to join the coalition, China will be the alternative partner already present. When the petrodollar system faces its next stress test from disrupted Gulf oil flows, China's yuan-denominated oil trade with Iran will be the established alternative that gains legitimacy by default. China does not need to fire a single missile to win this conflict. It needs only to keep buying oil at a discount and wait. In 415 BC, Athens launched its expedition to Sicily with overwhelming military force. Every tactical calculation was correct. Every strategic assumption was catastrophically wrong. The expedition was destroyed not by superior Sicilian military power, but by the strategic exhaustion of an overextended empire that had miscalculated who would benefit from the war it started. America is spending $1.5 billion per day. China is saving $13.8 million per day. Iran is receiving $83 million per day in oil revenue, and the war continues. The question is not whether China is winning this conflict. The arithmetic answers that question definitively. The question is whether anyone in Washington has done the math, and if they have, why they are not saying it out loud. Someone has to. This is Conflict Cipher, decoding the wars they don't explain. See you in the next one.